Hello everyone, my name's Natasha Turner. Welcome to this event on how ESG investors can approach fair tax. So today's discussion is just one of many events going on in Fair Tax Week this year, which runs from the 8th to the 18th of June and is organised by the Fair Tax Foundation. To find out what else is happening over the course of the next few days, you can go to www.fairtaxmark.net, but I assume you guys are all up to speed on that and that's why you are here today. I'm the global editor at ESG Clarity, which is a B2B publication for ESG fund selectors in Europe, the UK, Asia Pacific, and the US. We write mainly about the asset management industry and how its players are approaching fast evolving investment approaches such as ESG, sustainable, and impact investing. But to be honest, tax conduct at the companies that asset managers invest in don't really feature much in the conversations that we have with them, with the media, as compared with climate or board diversity, for example. But investors have always looked at companies' tax disclosures and tax reporting and transparency as clearly an indicator of good governance or some form of governance at least. So we'll be hearing sort of more about that. But just like how reporting on modern slavery doesn't sort of get rid of modern slavery, some responsible investors want to go further than just encouraging tax reporting and actually ensure that tax paid by the companies they invest in is fair. And there's also the fact that tax disclosures and reporting are becoming an increasing focus of ESG standards, frameworks, directives, things like that, which I'm sure we're going to come on to later. There are a few investment firms that are looking inwards as well and are receiving the fair tax mark themselves, but there's not that many. One of these firms, though, is Epworth, whose Chief Responsibility Officer, Andrew Harper, is one of the panelists today. And I'm looking forward to hearing more about how Epworth looks at tax as part of its ESG approach. We're also going to hear from Sebastian Agbeck, who is a corporate governance analyst at the Principles for Responsible Investment, which is a global network of sustainable investors, meaning Sebastian can give us kind of that bigger picture view of how approaches like Epworth's can be adopted at all sorts of firms around the world. Then we have Joe Holmes, head of ESG reporting at Marshalls, to give us kind of the other side of the coin, how companies can report on tax for their investors. And then Paul Monaghan, Chief Executive of the Fair Tax Foundation, is going to share some thoughts from the Fair Tax Foundation about ESG and tax and where this discussion might be headed in the future. So the way it's going to work is that each of our esteemed panelists is going to have a few minutes to present to you. Then we're going to have a short discussion and then open things up for questions. So do submit your questions in the Q&A box. You can submit them as and when they come into your head. We'll pick them up for the Q&A at the end. So we're going to kick off with Andrew, who I mentioned is Chief Responsibility Officer at Epworth Investment Management. Andrew handles all matters related to ethical investment for Epworth and the Central Finance Board of the Methodist Church. Before joining Epworth, Andrew served as Director of Global and Learning Innovation at the Methodist Church. So over to you, Andrew.
Thank you, Natasha. So as mentioned, I work for a company called Epworth Investment Management, and we're a small asset manager that seeks to meet the needs of charity clients specifically. And we're proud to boast that we were the first UK asset manager to achieve the fair tax mark. And we continue to journey with the Fair Tax Foundation to encourage investee companies to commit to paying what they owe, where they owe it, and on time. In recent years, the issue of corporate tax avoidance has received growing attention and scrutiny. Our very gathering today demonstrates the increased interest. Multinational corporations taking advantage of loopholes and offshore tax havens have often paid minimal or no taxes, despite reaping substantial profits. This has led to a bit of a public outcry as citizens and governments rightfully question the fairness and equity of such practices. But why should we, as an asset manager, care about this issue? Well, as stewards of our clients' investments, it's our duty to not only generate financial returns, but also to consider the broader societal impacts of our investment decisions. So I want to give you three key reasons why we should all, not just as asset managers, but all be concerned about invested companies paying their fair share of taxes. Firstly, tax avoidance erodes trust and undermines the societal contract. When companies exploit loopholes and avoid paying their fair share of taxes, it perpetuates the perception that the wealthy and powerful can manipulate the system to their advantage. And this breeds resentment and distrust among ordinary citizens, potentially fueling unrest and widening income inequality. As asset managers, we have a responsibility to promote a fair and sustainable economic system that benefits all stakeholders, and tax is a major part of that. Secondly, not paying a fair share of tax threatens long-term investment stability. Governments rely on tax revenue to fund public goods and services, such as infrastructure, healthcare, and education. When companies dodge paying their fair share of tax, it hampers the ability of governments to invest in these critical areas. Ultimately, this can lead to deteriorating infrastructure, an undereducated workforce, a less competitive business environment, and a society without the social provisions needed for human flourishing. I saw this all too prevalent in my time in Africa, where I spent 6 years working with some of the world's poorest communities. Resource-rich nations such as Zimbabwe would see billions of taxable revenue flow out of the country without the payment of tax. This abhorrent form of colonialism keeps nations in states of poverty and allows Western consumers and companies to enjoy relatively cheap products. Lastly, tax avoidance poses regulatory and reputational risks. Governments around the world are increasingly taking measures to address corporate tax avoidance. They're closing loopholes and tightening regulations. The potential for stricter tax enforcement is a risk factor that can impact the financial performance of companies. Additionally, investors and the public are becoming more socially conscious, seeking companies that demonstrate ethical behavior and contribute positively to society. So failing to address tax avoidance issues can harm both the reputation of the invested company, but also the asset manager. So what can asset managers and consumers alike do to ensure invested companies pay their fair share of taxes? Firstly, we should advocate for greater transparency and tax reporting standards. By encouraging companies to disclose their tax practices, we can identify and address potential risks. But that doesn't go far enough. So we can engage with invested companies, urging them to adopt responsible tax policies and align their practice with societal expectations. This includes supporting efforts to close tax loopholes and promoting tax reforms that foster fairness and responsibility. Furthermore, asset managers should incorporate tax-related risks and considerations into their investment analysis. By assessing a company's tax practices and potential exposure to regulatory changes, we can make more informed investment decisions that align with our clients' values and objectives. As chief responsibility of a charities-focused asset manager, I have a vested interest in ensuring that investee companies pay their fair share of tax. By addressing tax avoidance, we can contribute to a more equitable society, foster long-term investment stability, and mitigate regulatory and reputational risk. So I hope this webinar encourages us to embrace our role as responsible stewards of capital, wherever that may be, and advocate for a tax system that promotes fairness, transparency, and sustainable growth. Thank you.
Thanks very much, Andrew, and looking forward to picking up some of those points on engagement at the end. But now I'm very pleased to introduce Sebastian, who in his work as corporate governance analyst at the PRI, helps investors address corporate governance issues. His work currently focuses on tax fairness, corporate tax behaviour, both from a risk management and an impact-seeking perspective, and how investors can act. Prior to joining the PRI, Sebastian worked in sustainability reporting, helping companies across various industries improve the quality of their sustainability disclosures. So take it away, Sebastian.
Thank you, Natasha. And hi, everyone. It's a pleasure to be part of the Fair Tax Week. So just one quick word on the PRI. So PRI stands for Principles for Responsible Investment. And our goal is to help create a more sustainable financial system and to assist investors in achieving this by including sustainability factors into their decision-making, not just as the right thing to do, but in a way that also makes sense to the investment community. And one of these factors is tax. I would say since 2015, we've been raising awareness on the importance of tax as a sustainability issue. So we've produced guidance for investors, educational material. We've engaged with standard setters and policymakers, advocating mainly for greater tax transparency. And also we've facilitated the I think it's the largest global collaborative engagement between investors and companies between 2017 and 2019. Next slide, please. Oh yeah, that's fine. Next one, please. And yeah, next one again. Next one again. Yeah, that one. So thank you. I'll be very brief here because I think Andrew explained very well why a robust tax system is in the interest of investors, both from an impact investing perspective, but also from a risk management perspective. So I would just say at the macro level, for investors that have highly diversified portfolios, they effectively hold a slice of the overall markets. So their investment returns are not only dependent on individual assets outperforming each other, but also on the good health of the economy. And a robust and fair tax system is essential for that. Next slide, please. And at the individual firm level, let's say, all investors, whatever their objectives are, want companies to be profitable, and they want companies' profitability to be based on genuine competitive edge, so better products or services or better productivity, but not artificial tax planning, because that's not as sustainable as what I've just mentioned. Artificial tax planning might create an advantage in the short term, but then you have risks of greater enforcement or changes in tax laws, and that might create earnings risks for investors. And as Andrew mentioned as well, aggressive tax planning is increasingly being used by investors as a proxy indicator for poor corporate governance. Because it could indicate excessive risk-taking, overemphasis on the short-term financial results over the medium-term health of the company. And I would also add that you have the link between tax and ESG as well for the credibility of a company. When a company has a very ambitious sustainability program, for example, so they have very ambitious climate targets, etc., but they don't say anything on tax, so they don't disclose any information on tax. They're not willing to discuss tax with their investors. It doesn't necessarily send the right message about the integration of sustainability within the core of the business. And I think as we move forward, this is increasingly going to become a red flag for investors. Next slide, please. And I'll skip that one. Next slide again. Thank you. So on the investors' expectations, so I think very aligned with what was just said. So essentially, a growing number of investors expect companies to commit to not exploiting loopholes or inconsistencies between tax regimes to reduce their tax liability in a way that wasn't intended by tax regulators. So that's why in the responsible tax world, we often speak of the intention of the law versus the letter of the law. So we want companies to comply with not just the letter of the law, so the technicalities and everything, but also the intention of the regulators. And I think we all know there is a difference. So investors expect companies to publish a tax policy. And the objective here is to understand whether the company is focusing on minimum legal compliance or what I've just mentioned. So we would expect to see commitments on the use of low tax jurisdictions, a commitment to pay taxes where value is generated, etc. We also want to see governance controls in place to implement that policy. And our key expectation here is board oversight of tax issues, including responsible tax commitments, not just minimum compliance. And I think something that we haven't mentioned yet maybe is CBCR, so country by country reporting. I think this is another acronym, but you'll definitely have to memorize that one if you're looking into tax. So basically what we want to see is companies disclosing the tax payments that they make on a country by country basis, because this allows investors to see, okay, you have that number of employees in Spain, you have that amount of profit in Spain, but there are no income taxes being paid. Company, can you explain why? So it's really about promoting a better dialogue between companies and their investors. Next slide, please. Yeah, I just wanted to emphasize that I've just mentioned CBCR, so the tax payments on a country-by-country basis, but the qualitative information to explain the tax payments, to contextualize these numbers is just as important. Yeah, next slide, please. And yeah, so I've spoken about transparency quite a bit, and we need to go beyond transparency, and we need to move towards actually changing practices. But this is the context that investors have to grapple with. So only 9% of 1,000 key companies, so large multinationals, publish their country-by-country reporting. So that's why I think at the moment there is a lot of emphasis on transparency, because it's very low, basically. Next slide, please. Yeah, dialogue is key. So tax is a complex issue, I won't lie. We can't shy away from that. And that's why I think dialogue between investors and companies will be key to promote better understanding between the two. These are examples of questions that investors are asking companies. And I guess a key message here is for investors, if there is a lack of response from companies, I think the key is to persist, basically, because the more companies hear from their investors that this is an important issue, the more likely they will be to prioritize this issue. Companies need to hear from their investors, not just like civil society or regulators. Next slide, please. Yeah, just to say that investor stewardship is definitely increasing. Last year, we saw 3 shareholder proposals asking for more tax transparency at Amazon, Cisco, and Microsoft, and they all did pretty well. This year as well, we saw another 5 shareholder proposals on tax asking for country-by-country reporting, all of these, and they did also well considering the more difficult context this year. Next slide, please. And so what can investors do? So as the title says, sustained investor pressure and interest is key to effect change. So investors can publish and communicate expectations to portfolio companies, to investment managers, the expectations that we've just outlined. They can use those. They can evaluate tax transparency practices and risks among their portfolio companies. They can collaborate with others. They can support policymakers, and they can look into their own tax practices as well, like Epworth is doing. And I'll close now, but I would really emphasize that you don't need to be a tax expert to include tax in your investments. You don't need to be a climate expert to ask for emissions data. You do need some understanding of what emissions data are, Scope 1, Scope 2. It's exactly the same for tax. So thank you.
Great, thanks very much, Sebastian. Just another reminder that you can put your questions into the Q&A box now, and we will pick them up at the end. But now on to Jo Holmes, who's head of ESG reporting at Marshalls. Having spent much of her career in communications and sustainability, Jo went on to become an academic, delivering leadership, management and sustainability programs for degrees and professional qualifications. Jo joined Marshalls in 2019 and now leads its ESG stakeholder engagement and reporting. So over to you, Jo. You are on mute, Jo.
Of course I am. Schoolgirl error. Okay. Are you okay? Can you see the screen okay? Okay. So firstly, sorry, I'm going to be looking sideways because I've got two screens. Just bear with me on it. So thank you for asking me to be part of this webinar. We're Marshalls, and I guess I ought to sort of say, you know, who we are. So we are a manufacturer of products for the built environment. So that's landscaping products, building products, roofing products. You'll see us as part of the UK infrastructure quite a lot. We've contributed to a lot of really sort of big and small projects. It's almost like Sebastian and I had a psychic link, because I'm going to start by saying I'm not a tax expert, because my role actually is on ESG reporting. My role is about communicating those ESG sustainability credentials, and that's what I do. So I just wanted to sort of mention that. We use this diagram internally, actually. It's not technically some stuff that we would usually, but I thought it was worth pointing out, because tax transparency for us is one part of a large whole. We kind of created this maybe about a year ago, I think, to start sort of being able to communicate what ESG meant for us, because over the years, and certainly when I started in communicating and reporting this stuff, which was, I don't know, around about the sort of early 2000s, 2005, something like that, I was doing CSR reports. Then it went to sustainability. Now ESG has become much more of a prevalent word. That said, ESG began and certainly is still an investor term. So we wanted to be able to communicate that. And as you can see from here, there's lots of different elements for us in terms of what we want to be able to say. And tax transparency is one of them. I also wanted to give a bit of an overview of our journey, I suppose, and the fact that tax is, again, one part of it. But in terms of what we want to be able to do, you know, it's about best practice. It's about doing the right thing. And having the fair tax mark is one of those things. So we've had that since 2015. And it's a really important part of our ESG credentials, actually, because it speaks to our commitment for doing the right thing. I wanted to start sort of now bring it back to what we're talking about today, and that investor approach towards responsible tax conduct, and why we believe tax is one of the areas that we do want to be communicating about. It is part of a commitment to transparency and disclosure. So we report against GRI and SASB. Also, we have materiality assessments. We do look at the kinds of things that we want to be communicating to all of our stakeholders about, but transparency, disclosure is absolutely one of those, and that's where the fair tax mark fits in very much so. It's about, when we're paying tax, it's about the right amount, the right time, in the right place. And I'll be honest, I think sometimes when you just look at that, you think, well, of course, the right amount, of course, at the right time, of course, in the right place. But as both Andrew and Sebastian have said, that's not always the case. So it is quite specific that we do those things. One of the really big ones for me is, and as you saw in my first slide, who we are is we're part of the infrastructure. We have a role in society. We are part of iconic buildings and schemes and all sorts of the building work that goes on in the UK. So paying the right amount of tax in the UK, which is where we're based, is absolutely the right thing to do, because that's our role. This is where we are, as well of course as being best practice. So the interesting bit, and in fact, Andrew said this in his speech just earlier on, and talked about trust. And I found this in one of Edelman Trust barometers from last year, their 22 report, that started that's been saying really that out of all of the organizations that one can put their trust in, business is the one that's trusted to do what's right. Well, that's quite something to live up to, I think, as a business, that, if you're more trusted than a government and media and an NGO, wow. So there's a role to play there too, in terms of communicating what's right, in doing the right thing. Also, Fair Tax Nation, that Fair Tax produced, again, about public attitudes to tax conduct, and saying that actually, the public wants businesses to be transparent about tax conduct, and in order to communicate that, and disclose that transparently. I thought this was quite a good one too, because it starts to look at it's slightly more detailed. Again, back to Edelman, this one is their 23 from earlier this year, and looking at not only is business the only trusted institution, but by a bit really, and in terms of how little perhaps other institutions are beginning to get trusted. So that does put quite I don't want to call it a burden, I suppose, but it does put some weight on businesses to be transparent. I kind of wanted to come back, I guess, to the role that we play and being part of the infrastructure. I just took a screenshot from our case studies page, but the fact that as a company, it's very much about appropriateness. And I always think back to materiality, especially in my role, and what is material. And actually, if we are part of the infrastructure, if we have got our role in society, then of course we've got to pay the right amount of tax. Now, let's pop a little spanner in the works. Greenwash, we all have heard that, of course, greenwash. I remember that from, again, the early 2000s, about 2006, 2007. Greenwash about, basically communicating all these lovely things about yourself to make you appear to be green or eco or sustainable, when perhaps, the reality may not be so. But I wanted to share this, which a colleague of mine found, which we thought was fantastic, because now it's not just greenwash, it's green crowd and green light and green shift and green label. And the one I thought was super interesting for us today is green hushing. And the fact that corporates might want to underreport or hide their credentials, actually, in order to evade investor scrutiny. And if they don't sort of say anything, then perhaps you won't be looking at me. But that's an interesting one, isn't it, from the disclosure perspective, because both Andrew and Sebastian alluded to the fact that things are absolutely hotting up, that we have got far more scrutiny on our sustainability credentials and the way in which, as a corporate, we must behave. We're a PLC. We already have mandatory requirements, whether it's TCFD for climate, whether it's, of course, gender pay gap, whether it's modern slavery statement, all of the different things that we have to do, on top of these international standards now that are coming in all over the world, actually, but are coming in to be able to compare companies, because part of the difficulty has been for the investor community to be able to compare a company with another company with another company, if we all choose to disclose whatever we want to. If we are told to disclose certain things, and of course then you're able to compare better. But that's an interesting one, and I wanted to sort of bring this greenwash hybrid or whatever it may be, that sort of shows that this space is moving, and there are so many different ways in which the water can get murkier. I wanted to, I guess, bring it back to the start of what we were talking about, which is about investor approach. Now, I found this online. I'm sure there's perhaps an updated one or whatnot, but it was more to share with everybody, on this webinar, the multitude of different ESG ratings agencies that corporates, especially us as a PLC, that we have to deal with. I'm not saying we deal with every single one of them, but looking at that, not far off, I would say probably 80%. And we are asked different things. We are asked all sorts of different things about our sustainability credentials, about how we manage the E, the S and the G. And again, Sebastian alluded to this earlier, as much as we are asked a lot of information about the E, the environmental, the climate stuff for sure, carbon, etc. Yes, we're asked a lot about governance. But one thing we don't get asked a huge amount about is tax and tax reporting and tax disclosure. Some do, don't get me wrong, and I did have a look at this prior to the webinar, again, to remind myself as to which ones do ask about tax. And they don't all ask about tax, and the ones that do, some ask maybe that's sort of 4 questions, some it's 1 question. The depth isn't necessarily there at this stage. I'm not saying that it won't be, but that's interesting too, that actually even in the elements where we are measured as a corporate, we're not being asked the question. And so I guess that comes back to why we are Fair Tax Mark accredited. It's because we want to show that we have got that transparency, that disclosure, that we are committed to paying our fair share of tax. So it'll be interesting, and I'll be obviously very, very keen to watch this space as to how this all evolves, because at this stage, tax is perhaps not as high up on the agenda, certainly with ESG ratings, as we might like it to be. So I shall end it there and stop sharing. And hand it over to you, Natasha.
Great, thanks for, interesting to hear about it not being so high on the agenda. I feel like that's what I would sort of assume as well, so maybe we can get into that a bit later. But now, just before we get into a discussion, I want to introduce Paul. Paul was co-founder of the Fair Tax Foundation in 2014 and became chief executive in September 2017. Previously, he was architect of much of the UK cooperative movement's ethical and environmental excellence for nearly 2 decades. And before that, he combined biological sciences research with campaigning on third world debt and ethical lending. He also led sustainability programs across the cooperative group in areas such as food, banking, insurance, pharmacy, funerals, and travel. Contributions included the creation of programs of environmental management, ethical finance, sustainability reporting, and a commitment to campaigning and progressive public policy intervention. So very well-rounded view, and very interested to hear your thoughts, Paul.
Thank you, Natasha. And I think that CV being read out proves that if I can get into tax and get on top of it, then anyone can from a biochemical background. This is about the 4th or 5th webinar that we've had going in Fair Tax Week. I just need to say we had a couple of comments from some of the others that plants at the back of me were looking a bit dishevelled and needed a water. They have been watered this morning, and I think that just proves at the Fair Tax Foundation that we're both open to feedback and responsive. So thank you for those comments. We believe that businesses paying tax responsibly should be recognised and celebrated, and that the global race to the bottom, tax competition, should be resisted. And I think, as I'll hopefully cover in this few minutes, I think there's a lot to celebrate. I think a couple of comments have rightly been made that it is still the case that most investors do not raise tax in the ESG conversations. Most don't. But it wasn't so long ago when none did this whatsoever. And it was the pioneering companies who were raising it with the investors. So we're not where we want to be. We've made tremendous progress, and I think that needs to be celebrated. The Fair Tax Foundation, we see ourselves as rooted in the corporate sector and civil society. We've got a couple of FTSE listed businesses on our board, as well as Oxfam, as well as pioneers of ethical consumerism. And I want to take the opportunity to say that we are actually looking round for a mover and shaker from the institutional investment asset management world to join our board. So if that's you on the other end of this call and you're interested, please phone us because we want to talk. Our bread and butter is the Fair Tax Mark, which is an accreditation scheme for business. We like to think of that as the gold standard of responsible tax conduct. It covers co-ops, small business, big business, but it also covers a whole series of listed businesses, both in the UK and abroad. Everyone from Watches of Switzerland to Orsted to Marshalls to Gleason's, and we've now got asset managers involved. Epworth who are on this, also Jupiter Asset Management, FTSE listed, Ethical Investors, Ethical Screening, brother sister companies, all together. The businesses with the Fair Tax Mark accreditation now cover about 250 trading brands, 250,000 employees, and pay something like, in terms of corporation cash tax paid, anything between, it's basically about 1.1 billion UK pounds or 1.4 billion US dollars. So making a combined decent contribution. Our view is the world is changing. And I can't example this far better than looking at the UN Sustainable Development Goals. So we see a number of businesses now coming to us and saying, I'm going to do responsible tax because it aligns with these UN Sustainable Development Goals. And that's my rationale. However, you will not find tax in the UN Sustainable Development Goals. It was taken out at the behest of large multinationals way back when who did not want it in there. So we're in this perverse position of people now retrospectively going back and fixing something that shouldn't have been broken in the first place. I think that's one of the best examples for me of the degree to which responsible tax conduct has come in from the cold. Joe put up that slide before with all the different agencies and rating agencies that are out there. Actually, we've been working with CSR Europe on a project to map these and to try to come up with some solutions. We've been looking at institutional investors, asset managers, and rating agencies. So I was just going to share some of our thoughts just on the rating agencies. I need to caveat it with our analysis is based on stuff that is already in the public domain. We haven't gone back to the rating agencies and said, have we got this correct? But here's what our findings were looking at the big rating agencies. Good, the bad, and the very, very ugly. So we saw a range of methodologies amongst the rating agencies. Some would send detailed questionnaires out to companies and ask them to fill it in, S&P Global and Moody's, for example, whereas others would not send a questionnaire out. They would just do a desk-based analysis from a distance. The reason I'm talking about and I'm concentrating on the rating agencies is because they tend to inform a lot of the asset managers and the institutional investors anyway. Secondly, there was a range of materiality determinations. Most claimed, at least in public, to take account of tax conduct now. A couple outliers didn't, such as EcoVadis. We could see no reference whatsoever at EcoVadis. There were some common expected themes, but we couldn't discern a weighting. And we have a suspicion that the weighting system is very important. And in some instances, the weighting system takes tax conduct down to zero as a consideration in some sectors. But the areas that were coming out as common themes, as you might expect, were asking questions about policy, risk control and governance, and that these should be public disclosures. There was a push, as Sebastian and others have talked about a public commitment to adhere to the letter of the law, as well as the spirit of the law, as well as the letter of the law. And also, interestingly, there was a big push that we could see against profit shifting and the artificial use of tax havens. And the other area was narrative. So, yes, we need to see public country by country reporting. We need hard data in the public domain, but we also need a narrative because it's useless without the narrative. Because there are many businesses who've got legitimate reasons to be in what would be termed tax havens because they have a genuine economic presence there, they're adding economic value, it's real. So without the narrative next to the raw data, businesses create problems for themselves. So we're a big fan of the narrative going next to the data. There was some welcome overlap with the civil society agenda and the agenda of people such as us, such as on public country by country reporting. There was also one big gap that we could see that stood out, certainly from the Fair Tax Foundation's perspective, which is that very little a discussion of beneficial ownership disclosure, i.e. the people who own it, putting that in the public domain. Because at the end of the day, if you don't know who owns the thing, then you can't get to the bottom of whether the right taxes are being paid in the right place. Some other really interesting big differences we spotted was tax controversy was actually a KPI for a number of rating agencies, Sustainalytics, Refinitiv, MSCI. Sometimes it was as crude as how many bad references have you had in the media over a certain point in time? Now, that is a real challenge for a business to wrestle with. How do I respond to that? Kill stories before they get to the press? I mean, is that what we're saying? So I think what we're seeing here is that tax conduct is basically where carbon reporting was 20 years ago. It's just starting to emerge. There's some wonderful things happening. There's some less wonderful things happening. But generally, it's to be applauded. Now, it's easy for me to sit here and have a go at everybody else without putting our own solutions forward. So I'm going to do that now. I'm going to suggest, and it's a bit of back of a fag packet, it's a work in progress. Rip it to shreds in the Q&A if people want to, or endorse it, whatever you think. I'm going to suggest 5 focus areas now which was what Natasha set out at the beginning. What should ESG investors look for? These are the 5 focus areas I would suggest. Each business, there should be a public provision of a full list of all subsidiaries and the tax residency of each. You don't get that, for example, in the US right now, although you would get it in the UK by law partly. There should be, number 2, public country-by-country reporting of financial data, as has been discussed, with a narrative to explain any unusual positions. Number 3, the public policy that is in the public domain, let's assume that's a given right now, it should explicitly discuss matters of tax avoidance and tax haven presence, and that policy should be subject to annual compliance confirmation by the board. That's number 3. Number 4, there should be disclosure of the size of any uncertain tax positions / uncertain tax benefit. An uncertain tax position, without going too nerdy, is where a business is required to calculate all the instances where it thinks it's going to lose with the tax authority and what the impact of that would be if it was to lose. And you actually have a whole methodology and a requirement for that. Some businesses disclose that, some businesses don't. So number 4 would be the disclosure and the size of uncertain tax positions. And number 5 would be an analysis of cash taxes paid over 5 years. Not the total tax accrual, not the deferred tax position, not the current tax position, cash taxes paid over 5 years. So just before I end, one last quick thought. We've come a long way. We've not won, but we are winning. There's been some massive positive developments at the OECD, the UN, and at a country level. So take 2 examples. In the UK has gone from competing with its corporation tax rate with Saudi Arabia and Russia, the lowest in the G20, to now being middling for the G7, which is a positive. Or we go to the other side of the world and look at Australia. The tax transparency requirements that are being proposed in Australia really are radical. And I think one of the things that people don't grasp is that if Amazon triggers the threshold in Australia, which I believe it does right now maybe they'll get below the threshold by shifting income elsewhere. But right now, I believe it triggers the threshold. Amazon in Australia would have to publish a full public country-by-country report for its activities in the world, not just Australia. Therefore, we would know the position in Germany and the UK, etc. This is radical. If this happens, it's unbelievable. It's still draft legislation. There are many dark forces trying to kill it, but we could be on the verge of something very, very special. And touch wood, ESG investors could be being drowned in data very soon with which to factor in these issues. That's me. Thank you.
Thank you very much, Paul. And it's great to end on a positive note there. I'm sure we could probably fill a whole other webinar just talking about ESG ratings agencies. And, you know, it does seem like asset managers are kind of focusing more on things like their engagement strategies, ESG asset managers, you know, over sometimes some of the ESG ratings for, you know, a number of reasons. Joe, in the questions you get from investors, I mean, I know you said it's not as many as others on tax, are you seeing that this might be the case, that there is more focus on engagement and questions like these? And is it any of the questions about things that Paul just mentioned?
So there was one that I was looking at last week. It is quite specific, and it's much more focused on the country by country, and which we haven't tended to report on. That said, we've had an internal discussion about sort of whether we will and what we think about that. And the questions are they are more about, do you have a policy, and and basically, have you set out that you won't use tax havens? Have you said that you're not going to do the things that we've all been talking about? But it doesn't go any further really than that. Do you know what I mean? It's just not in depth. That said, I don't also want to necessarily sort of bash it either. There are many different elements that also don't get talked about in depth with ESG ratings. It's just because there's so much, and again, it comes back to materiality for each company. What is important? We've got the fair tax mark. Why? Because we think it's a really important thing to have. We're predominantly UK based. We want to pay our fair share of tax in the UK. Why would we not? That's sort of how we would see it. So yeah, it's an interesting one. I will keep an eye, because I did have a look at all the different ones. I deal with about 9-10 altogether, and some don't have anything at all, and some literally have about 3 questions. Some it's not much more than that really in comparison to the rest.
Mm-hmm. Well, yeah, we'll see how that develops over time, I guess. Sebastian, there's a question in the comment box, and it's similar to one I was going to ask as well, about the resolutions that you mentioned. We're sort of coming out of AGM season now, and the question is about if you can share the kind of percentages of support, I suppose, for those. And I also just wanted to understand why there is kind of less of a focus on tax resolutions than, say, climate or diversity.
Yeah, thanks. Yeah, I've just typed an answer. So what I would say is the 2022 proposals all got more than 20% votes in favor. Now, outside the investment world, that might not sound like much, but it's a lot for first-time proposals. Some climate proposals that have been filed every year for 5 years get 45%, 50%, so 20% is really not that bad. It's also the threshold above which a corporate governance principle, a basic principle, says that companies need to respond to the interests of shareholders. For the 2023 proposals, first of all, we got 5 proposals, so more than last year. There were only 3. And I saw there was a question about investors. I would say one of those 5 proposals was actually filed at an investor, so Brookfield's Asset Management, one of the largest asset managers in Canada, and I think even globally. And it got 26% votes in favor. This is not confirmed yet, but I think that's what the temporary vote result is. And 2023, so we got lower levels of support. You'll see that in my answer, but 2023 was a bit tougher from what I heard in terms of support generally for ESG or sustainability proposals, and other mainstream proposals got less than what they got last year. Just on last year, I would say Amazon was the first company that was targeted by a shareholder proposal, and they tried to exclude the proposal from going to a vote, and the Securities and Exchange Commission actually ruled in favor of investors. And there was a big letter that was sent, a letter that was sent by investors with I think 40 investors signing it, to advocate to the SEC, the Securities and Exchange Commission, for the resolution to go to a vote. So yeah, that's my answer.
Encouraging, yeah.
Yeah, very encouraging.
Thanks. Andrew, so can you tell us a little bit about yours, or maybe just an example of kind of an escalation strategy when it comes to tax? So if you are engaging with your investee companies on this, or requesting tax reporting, that kind of thing, what's the next stage? Would you divest from a company over this? Is that what is the general kind of thinking for asset managers in this area? Where does that go?
Yeah, sure. I think it varies across geographies and kind of size of the investee company. It's a lot harder for us to pick up the phone and talk to the CFO of Amazon than it is to pick up the phone and talk to the CFO of someone like MJ Gleason. And so we would take different strategies. It's also a lot different when you're talking about UK-based companies. The US tax is a very dirty word. And so there's a huge education piece to happen here to get tax to be something positively we can think about to address some of the big social issues. So we see a lot more potential in the UK and Europe in particular around tax. In terms of escalation, I think it's about just hammering home those points that have been made here today, that this is about building up brand trust. This is about mitigating risk. This is about being a positive contributor to society. And I think we can often forget that companies are made up of people. And people, they're just like us on this call. There's a deep care for people and planet within these companies on an individual level. And so we can leverage that kind of emotional response, that human response into the fair tax conversation. But I would say if we can get to a higher level conversation with a company, getting to talk with the CFO, then the conversation goes much smoother. And there's almost a bit of a light bulb moment for people when they say, oh yeah, why haven't we looked at this before?
Mm-hmm. And it might be slightly different for you because your clients are charities and things like that, but do you ever have to juggle those potentially competing interests of client wishes in this area and then sort of corporate movement on tax?
Yeah, I mean, ultimately, our clients want to make a financial return. They don't come to us just for goodwill. But I think our clients are unique insofar that they're on the front lines of many of the social issues facing the UK and the world. These are charities addressing things like mental health, addressing things like housing, veterans affairs, things like that. They're on the front lines of issues that would be better or best addressed by governments. And if governments had their fair share of tax to be able to put towards these issues, we may not have so many issues, or we may be further down the line in resolving them. So they see it very much as part of their mission as well, in terms of their investments need to actively work to fulfill their mission, not just sit in the background ticking away. And so part of that, charities need money, they need support of governments to address the issues that they're looking at, and tax is the best way to achieve that.
Mm-hmm. Great, thank you. Paul, so there's a question from Dave that I'm hoping you can address. So it's saying there's been a lot of attention on fair tax practices at companies, but what about tax structuring itself when investors, for example, invest in a private markets project, like a large infrastructure project? In other words, there's a lot of emphasis on companies and less on the asset managers themselves. I know you talked about a couple that have received the fair tax mark, but yeah, can you any thoughts on this question?
No, it's really, really good question. We love the Global Reporting Initiative as much as we love UNPRI, and we tried to make sure that when we launched our Global Multinational Standard that we were asking the questions in the same way, so that there was corporates ain't nothing more than having multiple forms with slightly different variations of the same question. So we made sure that didn't happen. So that's just a little bit of background. So what we do at Fair Tax Mark, we look at the parent entity. We look at the whole group. We're not like B Corp certification where they'll let you look at a subsidiary and just get the subsidiary certified. So you could get Nespresso done if you were part of Nestle. We don't believe in that. We believe you can only assess responsible tax conduct if you look at the whole group. And therefore we focus on the whole group and the consolidated accounts. Now we're a project where the investment in a project is beneath the threshold to appear in the consolidated report and accounts, i.e. it might be a 20% stake in a joint venture, where that currently is within our direct remit of assessments because it's not in the consolidated report and accounts. But what we are starting to do is with our partners, accredited businesses, is asking them to introduce us to the business that is the major stakeholder in that project, where those report and accounts exist, and trying to go back up the train. So almost like coming down, going across and going back up. The one thing I will say is if the question is alluding to private equity, is we've had instances where a listed business has sold some of it, sold part of its operations to private equity, and that business that has then gone over has asked us for a Fair Tax Mark certification. And whilst we would love to do it in theory, the way we look at it is if private equity has control over that operation, we would need to assess private equity provider, not just the investee. So that for us is a line we currently can't cross. So we have yet to consider any private equity houses. And I think it would be very difficult. But whilst they still have operational control in terms of appointing the management team, in terms of signing up the strategy, etc., we think ultimately the decisions on the aggressiveness of the tax strategy are ultimately therefore going to be set, at least in tone, by the private equity provider. So it's a long-winded way of me trying to answer that question.
Great, thank you. Okay, final question, and we've just got sort of 1 minute, so keep it very short. And it's back to engagement. So Seb, I'll direct this one to you if that's all right. So about giant tech companies being sort of most aggressive tax avoiders is the wording of the question. And saying that they're going to wait for regulation to move. So is engagement going to actually sort of move the dial in this area? I mean, I guess a lot of ESG funds maybe wouldn't even be holding these kinds of companies. So does that kind of skew the focus of engagement for investors as well?
Yeah, that's a great question, and I'm not very good at giving brief answers, so I'll try my best. We'll have to keep the conversation going. It's a great question. So tech companies are notoriously challenging to engage with. I would say, so will engagement ever be able to make progress in this kind of environment? Well, I would say no engagement is definitely not going to move them. If the more they see that investors have expectations on tax, the more likely they will consider it. And, last year we saw Amazon, for example, publishing tax principles. They're not very comprehensive, but that's still a move from a couple of years ago. We're hearing from investors, the largest ones, that some of these companies are starting to get back to them, take their calls. So there is some sort of progress. And I would say that, we're going to have a minimum tax that's going to apply to these companies, the OECD Pillar 2 tax. We're going to have the CBC, the country by country reporting in Australia that Paul mentioned. It's probably going to apply to Amazon, Microsoft, and probably Cisco as well. So yes, it's in 2 years, but they're still going to feel the heat, let's say. And the sooner they do it, the better for them. And there was another part of your question that I forgot. Yeah, ESG investors not holding these companies. Yes, that makes a difference, and that goes back to the evergreen debate of divestment versus engagement. But yeah, we have no time for that.
Yeah, Great. We will have to keep the conversation going.
Yeah, exactly.
Thank you very much to you all, and thanks for the questions as well. They were really interesting, and I hope you found this webinar very insightful. So do come back tomorrow for the event on tax justice perspectives across Europe, and hear from Fair Tax Mark accredited Danish energy company Ørsted, Oxfam EU Tax Justice Network, and CSR Europe. So thank you very much and enjoy the rest of your days.